A couple of reasons. The biggest reason is that it was expected. I think the expectation was 4.2, and they came in at 4.1. Is that what we're talking about?
Yes.
So, but then bigger picture, the average revisions to a GDP number, as I'm sure Steve will tell you, I think they revise it 7 times before they're finished with it. And even from the first to the second revision, it's anywhere from 1/4 to 0.5%. So this number is extraordinarily preliminary. And I don't think, by the way, that it was so weak or so strong that it would change anyone's mind or change anyone's positioning. I don't think there's anyone that would say, oh, wow, 4.1, this changes how I feel about rates, the dollar, economic growth, employment, et cetera. So that's where we are, and I think that's perfectly okay.
But, Doc, if I told you, the president says it's sustainable, maybe not at 4.1% or whatever, but if I told you that growth was going to be sustainable at 3%, we'd be pretty happy with that.
Yeah, you're going back to average then if you're sustained at 3. And if you're up on the upper end of 3 and pushing into 4 territory again, as Steve would tell you, that's pretty much a home run. This is a one-off. Let's see if we can sustain. But I have a lot of confidence that we'll continue to see good numbers, but probably more in the range that you just spoke of, Judge, more in that 3 range.
Liesman, what do you make of what the market is doing in response to what's a really good number? I mean, there's no two ways about it. It's a good number.
Yeah, it is a good number, and I think the market is trying to figure out how good it is. And I will tell you, it's a little bit stronger underneath than I expected it to be. I expected there to be a bump from inventories and a bump from net trade. We only got the bump from net trade. I think some of that goes away because I think we talked about the other day, this was the magic bean, which was soybeans, and people were ordering them ahead of time, and that ended up helping out the trade numbers quite a bit. But we got this minus 1% on inventories, and some of that could come back. So the inventories and the trade thing cancel each other out. I think one of the great questions for the market is you got this 4% increase in consumer spending. Some of that is probably the tax cut. Some of that is one time. And I'll give you the math on this real quick, Scott. Quarter to quarter, you get a bump in cash flow. You increase your spending. The next quarter, you don't get a bump in cash flow, right, from the prior quarter. So the growth quarter to quarter goes away. So I think we're trying to figure out how much of all this underlying is real. And I will tell you, my best guess right now is this 3% number is a good number. It's a number the market can bank on. I think the market may have already been
3% annual?
3% annual is a number you can bank on, I think, for 2 or 3 more quarters.
Is that Goldilocks, Steph? Is that Goldilocks for the market? Not too hot, good, not cold.
Yeah, absolutely. I mean, this is what I've been saying for a while, that I did think that the second quarter would be the peak in terms of the growth for the year. And I thought the first quarter was going to be the worst quarter of the year. So I still think second half of the year, it's 3%. 3% growth is good enough for double-digit earnings. It may not be 20 to 25% earnings, but double-digit earnings.
The wild card then becomes the Fed.
And then at 15 times forward estimates, because the multiples have come down substantially, you can make a case that the market is very attractive. So, yes, it does come down to the Fed, but I don't think the Fed is really going to – I don't know. I still believe that when we heard Powell last week or the week before, I thought he was – I did not think he was as hawkish as I had expected, and I had said it on the show. I think they are going to be data dependent, and I think we can handle 2 more rate hikes because the economy is actually doing well. And talk about Goldilocks. That job report was absolutely Goldilocks, right? So I feel still pretty good about where we are.
I think the point we're trying to make is you don't want the Fed to – I mean, people are long the market, don't want the Fed to have to growth to be so hot that the Fed's going to have to react more quickly and more forcefully, right?
I was just going to back up on what Steph was saying and really agree with her. The dovishness I heard in Powell, which I don't think is really dovishness, it's this. I think he's not prejudging that higher growth is going to create inflation. I think he's waiting to see whether or not that growth creates inflation. The danger is he falls behind the curve. But the upside is he doesn't cut it off before it happens.
Right, well, the PCE at 2%. It's at their mandate. But
at this point.
It's not on fire.
Can I ask you a question?
Under control.
Do you think that in some way the tariffs themselves or just the talk of tariffs in the air globally, do you think that does Powell a favor? Because maybe it lets him hang on a bit before doing the next set of rate hikes. Maybe it buys him a little bit of room if that actually does impact the economy, even if it's at the margin. That gives him the excuse to not displease the president and hold off a little bit?
With a market, Steve, that is 92% in September.
My best guess is Jay Powell and any central banker does not want to have to make policy based upon the kind of negotiations and threats that are going on with these tariffs. Maybe it does him a mathematical favor over the next couple of quarters, but if he had his way in this wicked world, as Peter, Paul, and Mary sang back all those many years ago, there would not be this kind of trade dispute going on that creates uncertainty as to the outlook for the economy and policy.
Jimmy, give me the outlook then for the market. I mean, all things considered, the outlook for growth, what the Fed may do, where earnings have come in. It's been a really pivotal week, especially in the leadership group of tech. Take it forward for me now.
Okay, thanks, Scott. You've given me the toughest question, by the way, because there is no way to say which way this is going to go. Let's take a look. I'm surprised none of us have talked about earnings because there are canaries in the coal mine here. Sorry, they're specific earnings. There are canaries in the coal mine here, okay? You had a number of manufacturers this week, GM, Whirlpool, amongst others, where the tariffs have hit home in their earnings, okay? So if the tariff issue becomes bigger, if the issue with China trade becomes bigger, then you're going to see more companies affected. That's number one. Number two, you've seen some companies, particularly in technology, that should not be affected by tariff, that really had a hard spell over the last week and a half.
Maybe because the stocks got a little ahead of themselves, right? I mean, you look at especially the FANG names.
It may well be, especially the FANG names. But here's the thing. We're sitting here asking ourselves, why is it such a tepid response today to 4% GDP growth? And you're asking what comes next. Next, what the market is saying, we don't really know. And to me, at least, this is very much dependent on whether there is any resolution, any softening, not resolution, softening in this escalating trade war with China, which frankly did escalate this week when China refused to approve the NXPI Qualcomm merger.